Imagine being able to give your child or grandchild a financial head start. Once your child turns 18, a lifetime ISA becomes a very good option. With careful consideration, what you leave behind can help your children and your grandchildren take the next steps in life with security and freedom. Well, imagine this, folks, a financial gift that grows quietly in the background but powerfully over decades. One that could set your child or grandchild up for their whole lives. And I'm not talking about a basic savings account here or a chunk of cash. I'm talking about a tool that with just a few relatively small contributions from you could turn into a genuine golden nest egg for their future. Well, in this video, we're going to be breaking down 5 powerful ways that you can give your children and grandchildren a massive financial head start. And we're going to start with, yes, you guessed it, pensions, which can be a really effective way to grow long-term retirement savings. And a little caveat though, results depend on individual circumstances and investment performance. Now, our advisors do get asked this next question quite regularly. Can I, as a parent or grandparent, open a savings account for my grandchildren? The simple answer is yes, you can. There are a variety of options to help save for your children and grandchildren's future. Let's go through the 5 most popular options. Imagine being able to give your child or grandchild a financial head start that could remove any retirement worries for them. A pension isn't just a savings account, it's a way to plant a seed for their future, letting it grow quietly and powerfully over the decades. Now, with a junior SIP, a self-invested personal pension, parents or grandparents can contribute up to £2,880 a year from their own resources. The government then adds tax relief of £720, free money that is, by the way, boosting this pot to £3,600. The money is usually locked in until the child reaches retirement age, but it can be invested in a range of assets, so it has decades and decades to grow. Contributing more to your own pension can also benefit your grandchildren indirectly. By topping up your retirement savings, you may free up other assets to gift now or later and potentially reduce the inheritance tax your estate might face. This means more of your wealth can pass on to them rather than going to the taxman, which can't be a bad thing. When it comes to passing on pensions, defined contribution schemes are generally outside your estate for inheritance tax purposes. I'm just going to say IHT from now on because it's easier to say. That is at least until 2027. If you die before age 75, your beneficiaries can usually inherit the pension tax-free. After 75, any withdrawals are taxed at the recipient's income tax rate. Either way, this isn't just money, it's the chance to give them a helping hand in life. It might be for education, it might be buying their first home, or simply giving them a financial cushion that lets them take opportunities you never could. Now, I've gone through a few points now, but if you're looking for a more in-depth conversation about this topic, or your finances and retirement plan in general, I really do encourage you to book in a call and speak to one of our expert team. We'll take a deep dive into your current finances, map out a plan to get you on track for the retirement you deserve, and you'll also see a live cash forecast of how your plan can be mapped out. But listen, don't take my word for it. There's a link in the description down there to learn more about our review, and you'll hear what our clients have to say too. Now, ISAs are one of the simplest and most flexible ways to give your children or grandchildren a financial head start without worrying about taxes eating into their savings. How do you do that? Well, a junior ISA as a starting point lets you save or invest up to £9,000 a year, that's the 25-26 allowance, in your child's name or your grandchild's name, completely tax-free. That's money that can grow over the years without being reduced by income or capital gains tax. The child gains full control at 18, giving them the freedom to use it for university, a first home, or even as a springboard into investing for adulthood. Setting one up is really straightforward. Parents or grandparents open the account on behalf of the child. They choose the type of ISA, cash, stocks and shares, or a combination, and contributions can be made regularly or as a lump sum. It's a really simple way to turn your gift into a long-term opportunity. Once your child turns 18, a lifetime ISA becomes a very good option. With a government bonus of 25% on contributions up to £4,000 a year, adding an extra grand into that pot for free, it's a really powerful way to help them save either for their first home or for retirement. Even if they're years away from either, the compounding effect over time can turn modest contributions into a very meaningful nest egg. Parents or grandparents can help fund contributions indirectly by gifting money, making it a collaborative way to invest in their future. So whether it's a junior ISA or a lifetime ISA, these accounts aren't just savings, they're a real way of giving children choice, independence and security as they grow. Now, trusts can feel a wee bit complicated, but at their heart, they're a way to protect and guide your loved one's financial future. They allow you to hold money or investments or property for a child or grandchild until the right time, helping ensure it's used wisely. A bare trust is simple and straightforward. Assets are held specifically for the child, and for tax purposes, they're treated as the child's own. Upon death, and when the child turns 18, they gain full control of whatever's inside that trust. Let's talk about discretionary trusts. These give you a lot more control for a lot longer over how and when money is accessed. This can be particularly useful if you want to support a child or grandchild gradually, or if you're planning for inheritance tax efficiency. Whilst the tax rules are more complex with this type of trust, the benefit is flexibility, and there's a great deal of it. The trustees can decide when to distribute income or capital, which can protect the funds from being spent too quickly or unwisely. With an interest in possession trust, the beneficiary has a right to receive income generated by the trust, though not necessarily the capital itself. This can provide a regular financial boost, like covering university costs, living expenses, or other needs, whilst keeping the principal intact for the future. There are other types of trust as well, which we haven't covered in this, but you can get in touch for more information. But they are a way to guide and protect your loved ones financially, giving you confidence that your support will be used in the way you intend, even long after you're gone. And if you'd like more information on a particular type of trust, comment in the comments. It'd be the sensible place to comment in the comments, and we might do a video just on that particular type of trust. Now, gifting money to your children or grandchildren can be one of the most personal and meaningful ways to support their future. It's more than a financial transaction, it's a way to share your wealth whilst you're still alive, to watch them benefit. You can give up to £3,000 each tax year free of inheritance tax. If you didn't use this allowance the year before, you can carry it forward 1 year, giving you flexibility to plan your gifts without worrying about IHT. It's a simple, legal way to pass on money whilst keeping your estate efficient. You can also give up to £250 per person each tax year. It's not a great deal of money, but it might help in some instances. That's also completely IHT free. Now, these smaller gifts can be perfect for birthdays, holidays, or little boosts that make a difference to their day-to-day lives, but that's all about IHT planning generally. Now, regular gifts from your surplus income is a really effective way of avoiding your IHT liability getting any worse and potentially reducing it. This is for money that you don't need for living expenses, and it can also be IHT free immediately. This could be a monthly allowance, it could be contributions to a savings account, or it could cover specific costs like school or extracurricular activities if you make it to your children and grandchildren. It's actually an excellent way of helping them now without compromising your own lifestyle, and generally the most useful way of capping or reducing an IHT liability. Now, with smart financial planning, there are ways to use your assets, pensions in particular, to generate more income, which you actually do not need, which can then be gifted and removed from your estate immediately. I was at a conference recently where a lawyer pronounced this as one of the greatest yet most underused means of mitigating IHT, so please read up more on that and get in touch if you want more info. Now, let's talk about larger gifts and the 7-year PET, potentially exempt transfer rule. If you survive 7 years after making a significant gift, it becomes fully exempt from inheritance tax. This can be a strategic way to move significant wealth to your children or your grandchildren whilst reducing the tax burden on your estate. The IHT liability is gradually reduced during those 7 years as well, so it's not a 7 years or bust strategy. Gifting isn't just about numbers, it's about giving your loved ones opportunities, easing their path in life, leaving a legacy of care and support that lasts well beyond your own lifetime, and stopping your wealth going to HMRC instead of your family, which I imagine you'd all quite like. Now, planning for IHT isn't just about numbers. I think I've said that a few times. It's about making sure that your hard-earned wealth supports the people you care about most rather than being eroded or eaten up by tax. A thoughtful tax planning today can give your children and grandchildren a stronger financial foundation tomorrow. At the moment, pensions are generally outside your estate for IHT, which means funding them has traditionally been a very tax-efficient way to pass wealth on. By carefully considering how you structure your savings, you can ensure more of what you leave goes directly to your loved ones. But from April 2027, changes are expected. Most unused pension funds and death benefits from them may be included in the estate for IHT purposes. Personal representatives could be responsible for reporting and paying any tax due. Some exceptions are likely to remain, we think, such as death in service benefits and certain annuities, but the landscape may shift significantly. I think it's very likely it will shift. Planning ahead now could give you time to adjust your strategy, although exact rules are not yet confirmed and of course, therefore, may change. But this shift has generally changed strategy from keeping your pensions and spend or gift everything else to spend your pensions and gift everything else. But it's not as simple as that, of course. It never is it, in financial services? If you don't know how IHT will impact you, please get advice. If you do know but are scared to start and gift money away, that's probably because you don't know how to gift properly and safely, or at all, both for you and your family. Fortunately, we do. And we work with a brilliant firm of solicitors for some joined up strategic thinking, so please get in touch. Using trusts, strategic lifetime gifts, and careful management of income and assets can help reduce your taxable estate. Make the most of your nil rate band, which is $325,000, and residential nil rate band, which is $175,000 if leaving your home to direct descendants. With careful consideration, what you leave behind can help your children and your grandchildren take the next steps in life with security and freedom. From pensions to ISAs, trusts, gifting and IHT planning, every decision you make today can have a lasting impact decades from now. That's whether you're planting the seeds of a junior SIP, contributing to a junior or lifetime ISA, or using a trust to protect and guide your funds, or making strategic gifts. The goal is exactly the same: to provide a helping hand whilst teaching the value of planning and foresight. By carefully considering the risk and suitability of each option and product, you can make informed choices that align with your family's goals. And even the most thoughtful inheritance tax planning isn't just about avoiding tax, actually. It's about ensuring your wealth supports the people you care about most, not the tax man. The key, of course, is to start with your own financial security, then choose the strategies that suit your family, your values and your goals. By taking a careful, considered approach, you can leave more than just money behind. You can leave your children and grandchildren confidence, choice and the foundation to pursue the life they dream of. So this video generally is about how to help your children and your grandchildren get more security and a better future. But what about protecting your current legacy from IHT? In our next video, avoid paying 40% inheritance tax, do this instead. We show simple, practical steps to make sure more of what you leave behind goes to your loved ones, not the tax man. So click here and I'll see you there.